So if you see the 3X on the daily or the 233 chart, then I'm going to use the weekly chart to help me determine my trend. If I saw the triple cross or the fat pitch or the 3X, whatever you want to call it, on the 55 or the 34, in other words, like an hour or a half-hour chart, then I'm going to use the daily chart to establish the trend. And the way that I establish the trend, please highlight and circle this sentence. I get this question all the time, and people miss this one sentence in the manual. The trend is determined by looking at the direction of the indicators, and you pay particular, no wonder you missed it, and I can't even say it. Pay particular attention to MACD. Now, it doesn't say ignore everything else. It says you look at the direction of the indicators, pay particular attention to MACD. And understand there's an art to reading a chart, and it takes time to develop that artistic eye. And as you're going through doing your practice trades, I'm going to tell you to trade some of them with the trend and trade some of them against the trend, so you can see how much easier it is to go with the trend. Let me give you an example of one here, and I usually don't do this for a first session, but I'm going to do it because it might save me a few emails. So let's take this section of chart from this white candle here on about August 20th. I'm going to go all the way up to where MACD crosses back down. So right about here on September 24th-ish. Now notice in here, price is just going up, right? It barely crosses the green line, but the red line is generally above the green. And even though like in this section right here, the red line might be pointing down, it never crossed the green line, right? So the red's still on top of green. And then in this section as well, you can see that Stochastic is going higher. It's going higher up until about here, and then it crossed down. So a little bit before the 24th of September. And then remember I said pay particular attention to MACD. MACD, red stayed on top all the way through here. Even right in this little section here, where while Stochastic crossed red under green, MACD stayed on top of the green, right? And so MACD stayed up this entire time. If this were a trend chart, the trend is going up, right? And it's been going up for basically 30 days, right? Ballpark August 20th to ballpark September 24th. So give or take 30 days. So that trend, if you were to call this the trend chart, and don't worry about the time frame on it, but if you call this the trend chart, now all I would do is I would look for, on a smaller time frame, try to find a 3X that was bullish, that would tell me I'm going in the direction of that prevailing trend. Let me say that again if you're new, and if you're experienced, you're going to go, oh, crap, that's easy. You've been looking at it wrong. So when I see that the indicators are up, right, red's on top of green on MACD, Stochastic is moving higher, price red's on top of green. What I do then, and I now drop down a time frame that corresponds to this, and now I'm looking for a bullish setup. Hit the band, spread the band, come off the band. Cover that for the new people in a few minutes. A bullish setup where it now is going up, and now I'm going in the direction of the overall trend. If you'll trade that way, this is a no-brainer. It's so easy. It's when you don't trade that way that you're like the cheetah that loses out to the, the little baby wildebeest that gets away from it, and then you go cry to the cheetah psychologist for hours on end because you're not a worthy cheetah. Go in the direction of the trend. This is so much easier. So now once you found the 3X, now you decide you're going to take action. So you found the 3X, you figured out the trend, you looked at other factors on there, we'll cover that later, and you decide to do the trade. The question becomes, when do you enter? When do you get in? So you can get in at or near the close of the candle that has the 3X, or at the beginning of the next candle. When I say at or near the close, as an example, the daily chart opens at, I'm speaking LA time, it opens at 6:30 in the morning in LA, it closes at 1 p.m. If you see a setup on a daily chart and it shows up within the last, 15-ish minutes or so of the day, if you want to get in there, I'm cool with that. I get it. Just understand, if you get in before the close of the candle, it's always possible that price could reverse against you before the candle closes, at which point you shouldn't be in the trade and you need to get out quick. If you want to get in near the open of the following candle, that's fine. Just understand, if you do it on a daily chart, it's possible that that next candle gaps up. And now you'll be faced with the dilemma, and you're going to face this for the rest of your life. Do you get in after the gap, or do you stick around and wait and see if it's going to pull back and maybe give you a better price to enter at? And Murphy's Law will appear. If you get in, let me know, because right after that, or in fact, tell you what, I'll tell you when I get in, I'll let you know, and then you can look to get in after I do, because it's almost a guarantee price will go the other way. And if I don't get in, it's almost a guarantee price will keep running north. No matter what you do, the market maker is going to screw with you. It's like he's watching your screen. He's got millions of other traders going, participating in the market and taking actions, and yet it feels like they're watching you. So you don't ever need to worry about them. It does feel like they're watching you. I promise you they're not. And the reason I can assure you that they're not watching you is because they're watching me. I know it. It just feels that way. Now, there may be times where rather than jumping in at or near the close of that candle that has the triple cross, maybe you want a more precise entry. And this comes in very handy when you're trading to get $1 an out or $1.50 an out. And so what you do is you now use a smaller time frame to look for that precision entry. And you can use the smaller time frame. What it does is it increases your confidence the price is now moving in the direction that you want it to go as soon as you get in the trade. And so I've got the smaller time frames listed according to where the 3x might be. So if you had your 3x was on the daily, you drop down to the 21. If your 3x is on the 233, you go to the 13, so on and so forth. I've got them listed out here. And what you do on the next page is using the smaller time frame is a choice. You don't have to. It's up to you. When you start off, I highly encourage you to use the smaller time frames. It will build your confidence. You're going to miss trades. That's fine. I don't care. But the ones that you do, it's going to build your confidence, and you'll be able to read charts better. As you gain experience, you may be less likely to use a smaller time frame, but that also means that you're willing to sit through a little bit of a pullback that a beginner would be uncomfortable with. When you look at, and you're gonna have to read this a few times, especially when you're doing the chart, just read each sentence and then go look how it matches up on a chart. When you're looking at the smaller time frame, the chart will look as if the move is already taking place for some time. And it's gonna feel like you missed the trade. So as an example, let me back up on this one. If this is let me go back to the one that had the lines on. If there's my entry, right, and let's say this is on a smaller time frame, and right about the time that I see this, I'll see this entry here on the daily chart. If I go look at a 21-minute chart at that point, it's almost a guarantee that the 21 will look just like this. It will be at the upper band, and it'll look like it have nowhere else to go. And that's very normal. You'll see that again and again and again. And so when you look at the smaller time frame, the chart will look as if the move has already been taking place, and you'll feel like you miss it. What you do is you sit there, you put your hand under your butt cheek, and you sit on it, and you wait for the chart to pull back. And a pullback on the chart, I've got the definition here. You want to highlight this. It's when price moves in the opposite direction of the 3x. So if I had a bullish 3x, that says a pullback means price is going to go down. And I'm watching the 21 for it to go down. Ideally, it hits the opposite Bollinger Band. It's not mandatory, but you'll find you practice enough of these, it tends to work better. After the price is pulled back, now I look for MACD and 2 other indicators to cross. They do not have to cross simultaneously. It does not have to be a 3x. Once you see that the 3 indicators have crossed, boom, there's your entry. That's where you pull the trigger. Before you get in, double check the 3X chart. You want to be sure that you've still got a worthwhile trade. In other words, do you still have enough room to get to the price target that you thought was worthwhile? Whether it's $1.50 to get out or whatever you thought was worthwhile. Be sure that it hasn't sucked up all that just as you're getting in. You got to be aware, not every triple cross is going to give a smaller time frame pullback where you can take action. And when that happens, you miss the trade. So what? Don't whine about it. The cheetah watches lots of animals leave the watering hole, and it doesn't go chase them. It waits for its target. The weak, the sick, the babies, the injured. That's what it's looking for. That's what you're going to look for. So if you don't get a trade, quit whining. Move on, look for others. Or go buy a cheetah pillow. You can buy them on Amazon. They cost you about $10. Snuggle up to it. Once you get in the trade, stop watching it on that smaller time frame. What you do is you go back to the chart that had your 3X, excuse me, and you analyze it on a candle by candle basis, and you follow the exit rules. And here's your exit rules. When you're new, when you make about $1.50 on the stock, get out. Or when the 2 and the 3 cross against you, get out. You got to wait for the candle to close or very near closing to determine if there's a cross. So, if you're in on the daily chart and the very next one crosses down midway through the day, that's not near the closing. You got to sit through that. And you can remain with this approach when you're not new, and you can really do well. What do I mean by well? You can make $1 million a year taking $1.50 profit again and again and again and again. Okay, you don't need to sit back and say, I got to get the 40% ROIs on options. That's ego talking. When you make your mortgage, you shouldn't have a mortgage anyway, but when you make your mortgage payment, when you make your rent payment, when you go to get to food to go, the person accepting your cash doesn't say, well, let me ask you, was this made from the $1.50 you made? Was this a 1% gain? Or was this a 20% gain? Because, at our restaurant, we only accept 20% gains for payments. That's bullshit. They don't care. The money is green. And so don't think that you got to stick around and go for the huge ROIs. What you want to do is be consistent. I use the analogy of Ted Williams swinging the bat at the plate. He's the world's best hitter. What I'm looking for. The best hitter in the major leagues in history. And most of his hits were singles. If you go to the Hall of Fame for baseball in Cooperstown, New York, it's heavily populated with singles hitters. There's a few home run hitters in there, but those guys have a lot of strikeouts. But the singles hitters do really well. You can just hit singles and be very, very comfortable. Once you get a lot of experience, what you can do is you can evaluate the trade as the stock gets to the next closest moving average. And then you got to be aware of a whole bunch of other factors, right? Including the time of the year, what the monthly tendency is, how long you've been in the trade, what AtCat is telling you, what the indicators are telling you. And or you just get out when you're happy. Call it done, right? If it's intelligent, perfect. And as you gain experience, you'll find that there is an art to exiting, and it takes time to develop that. And time is not 2 weeks. I don't want to hear from any of you saying, hey, I've been doing my homework for 2 weeks. I haven't found any trades. You ain't been looking because you're only looking on the right edge. You could go back and look 10 years in time and find trades, right? When you're new, you're looking all over the place. I'm going to give you a homework here in a little bit, which is to go find 3X's. I don't care if you find it on Tuesday or Wednesday's chart. I don't care if you find it in 1984 or 1997 or 2006. I don't care. And you shouldn't care either. What you want to do, Q-Charts has an unbelievable amount of history available there. Just go back in time and take the charts and go candle by candle by candle and look through them. See where you can find a 3X and watch how it performs. And just get used to manipulating your way around the charts. As you go through the trades, as you get into a trade, here's an example of the emotions that you're going to feel. So you're into a bullish trade. When you buy in, instantly you're going to feel this overwhelming sense of hope. as in, man, I hope this works, right? And you'll drop down on one knee and you'll genuflect. If you don't know what that means, it means you do the sign of the cross. You're like, please, dear God, make this thing work. And then God will smile on you and it'll lift a little bit and you'll feel this sense of relief. And then you'll stand a little bit longer and now you realize, hey, maybe this thing is going a little bit. And now you're optimistic. You think, hey, this could be a pretty good one. And it keeps going up and now you're excited and it keeps rising and you're thrilled and then you're euphoric. And now it starts to pull back a little bit and you're feeling a little bit anxious thinking, man, if it gets back up to that euphoria spot, I'll take it. And then the indicators cross down, red crosses green going against you. And now you're in denial that the trade is done because you want to get back up to that euphoria feeling, that euphoria price point, or even at the anxiety price point. You'd be thrilled to get that much back. But now the indicators are crossing against you, but you refuse to believe it and you're in denial. And now this price starts falling fast and you start to feel some fear. And then you're a little bit desperate thinking, come on, just give me a little bit more and I promise I'll close the trade. And then it falls even further and now you're in panic mode. And then you capitulate. Capitulate is a big, what's that, 8-letter word, 10-letter word for saying, fuck it. You get pissed off and you just close the trade and you develop a very profane vocabulary and you'll be pissed off at yourself. And then the price will drop down just a little bit more. And now you feel despondent because you really screwed it up. And then you feel depressed. It's like, man, look how much gain I had and I gave it all back. And then the stock will start to lift again. You look to get in that one or the next one and you feel hope again. And the cycle repeats all over. What I want you to do is I expect you to have a little hope when you buy in. That's normal. I want you to get out anywhere between relief all the way up to thrill, maybe euphoria. If it gets to anxiety, you got to be gone. You should have been gone before that. If you're in denial, get the fuck out. Not get the heck out, not get the hell out, get the fuck out of there. Quick, close the trade. Because what's going to happen is you're going to teach your brain all kinds of lessons that you don't, or start habits that you don't want your brain to take. Get the hell out. You can always get in another trade. Okay? So you get in at hope, you get out anywhere between relief all the way up to thrill. Worst case, you're out at euphoria. Ideally, you get out at thrill because you want to leave a little bit on the plate from the next guy. Let the next person buy it from you and it keeps going up. And you're okay leaving a little bit of money on the table. No problem. Some of you have the idea that, well, okay, I'm going to buy this stock at, let's say $100 down here at hope. And let's say euphoria is 110. And it's going up, and it gets to 109. And you're like, man, I can get another $1 out of this. I want to get that extra, that extra money will pay my electric bill this month, or it'll give me bragging rights or whatever it is. You don't want to do that. What you want to think of instead is let the next guy get the last little piece of it. Let him have the crumbs. You get the big chunk of meat. And you think, well, I don't behave that way. And I think the hell you don't. Take a look at what you've put in the trash off your breakfast, lunch, and dinner plate the last 3 days. I guarantee you have not eaten every crumb off your plate. There's been something that you've thrown away, whether it was leftover ketchup from the French fries, whether it was an extra little flake in the cereal bowl, a little bit of milk in there, a breadcrumb from your toast. Could have been the gristle from the meat, the beef, the steak you had. Could have, if you're a vegan, it was the little green tops from the carrots. Right? That's what, and you got to be willing to give a little, you got to throw some of it away. You throw away food now, and it may bother you, but you accept it. And so be willing to accept that you're not going to get every last nickel off the trade. You have to be comfortable, write this in your notes, with a chunk out of the middle. All you're looking for is a chunk out of the middle of the move. And when you start off, that chunk is $1.50 on the stock, $1 or so on the option. As you get better at this, you'll get a little bit bigger chunk, but you're never trying to get the whole thing. That will drive you nuts. Chunk in the middle is all you're trying to get. On the bearish side, same set of emotions, but in reverse. So the price is going up, starts to roll over. You buy in a put. And when you buy in, you say, oh man, I hope this thing drops. And then you relieve that it does. And then you're optimistic the sucker's going to zero. And then you're excited because it's on its way. And then you're thrilled, look at all the money you're making, and you're so happy. And all your coworkers are losing sleep because they're losing money in their 401k. They're all the GameStop guys that bought going up and now it's coming down. And you're thrilled that you're on the short side of it. Then you're delighted. Now you're invincible. Now you're euphoric down near the bottom. Now it starts to lift back up. You're like, uh-oh, feeling a little bit anxious. I wonder if this thing is over. Maybe I should have closed it yesterday. And now the indicators cross going back up. Red's back up on top of green. And now if you stay in, you're in denial. And the cycle repeats. What I'd strongly urge you to do, make a copy of these last 2 pages. The investor emotion charts, one for bullish, one for bearish. Stick it up over your monitors. And as you're going through doing trades, whether they're paper or real, make note of your emotions. What are you feeling as you're in there? Which one of these emotions best describes how you're feeling at that time? You want to learn to capture that so you can recognize it, because if you're not, it's going to bite you in the years to come. You got to be aware of that. You got to be on aware and on top and on tracking how you're feeling as you go through a trade.
Hey, Chris, I have a question.
Yeah, go ahead.
Hey, so my question is, usually when we look at when we have a 3x entry, we want our decision chart to be in the same direction of the 3x trade, right? Can you talk a little bit about how we factor in the direction of the sector and the market in general?
Not yet. I'll cover that later on. Okay. But at this point, Daniel, remember, I get beginners on the phone. You're talking at a high school level, and remember, I said before, I'm teaching people on here that are trying to figure out the sound of an A, a B, and a C. So let's not confuse them and throw calculus into the equation. Let me keep it at a simple level, but I'll cover that in the next, either in 2 weeks or in 4 weeks.
Okay, cool. Thank you.
Cool. No worries. Thank you.
Chris?
Yes, ma'am.
Yeah, I have a quick question, please. So for the bearish, where do you suggest we get out from the hope to invincible or delight? For bearish.
Hold on, I'm trying to can't find my mouse. The problem with too many terminals or monitors. So on bearish, you're getting in at hope.
Yeah.
And you're going to get anywhere between relief all the way down to invincible euphoria.
Mm-hmm.
Right? Worst case anxiety, you got to be gone by denial.
Okay. Must be gone by denial. Okay.
Because denial says that the indicators cross going the other way.
Mm-hmm.
Right? And we are you do this enough when you say, hey, well, if all the indicators cross, if I have a 3X and, red's pointing up, what direction is that going to go? And you go, well, that's going to go up. Okay, well, then why would you be in a bearish trade? Like, well, but I want it to go back down so I can get the money that I had 3 days ago. You're in denial. It already is telling you it's going up.
Right.
Right, but your emotional pull will be so strong that you don't want to admit that you missed it. And that's ego kicking in. Ego kicks your ass in the stock market.
True. Thank you.
You're welcome. I saw, and I'm going to get the quote wrong. Ego is the anesthesia for stupidity.
Yeah, it pumps you up. If you're trading, you don't even want the ego at all.
Just think of anybody that you know that's egotistical.
Right.
It's the anesthesia for stupidity. That's a little deep. Look somebody in the eye and say that, and then watch their fist. Be sure they don't swing it at you. But it's true. I mean, if you look at it, you can see it. Right? You got to be humble when you come at them. You got to be confident, but you got to be humble.
Right. Thank you.
You're welcome.
Hey, Chris, quick question on the pullback.
Yeah.
We were talking about with the precise charts, the precise entry. I can't wrap my brain around this. So we're waiting for the pullback. Ideally, it hits the opposite band, the opposite Bollinger Band. Are we waiting then for it to come off of that band to look for the 3X? Am I reading this wrong?
So right in this paragraph, Roman, it is Roman, right? Yeah, it's Roman.
Yeah.
So ideally it hits the opposite band. It's not mandatory, but you study enough of these, you'll find it works better. So it hits the opposite band, right? So let's say you had a bullish 3x on a daily.
Right.
Right. So I haven't covered this with the new people, but hit the band, spread the band, come off the band, give me a 3x on the daily. And now I drop down to a 21 and I'm watching for it to go hit the lower band, right? Because now I've got a bullish trade.
Okay.
And at that instant, that 21 is probably at its upper band.
Okay, so we're not waiting for it to hit the lower band necessarily.
And so now I gotta wait for the price to pull back a little bit on the 21.
Okay.
And so at some point in the next day, 2 or 3, whatever it may be, price will have a little bit of pullback intraday. And that 21 will go back down and tap its lower band, right? It'll tap the lower band on the 21.
Okay.
It might be at a higher price point than was my 3x, and that's okay. I'm okay with that. But now, so it hits that lower band on the 21, and then eventually it comes, if it hits the band, that's got to eventually come off the band.
Okay.
And now I'm then watching for MACD to cross, and I want to have 2 other indicators that also cross. They don't have to be at the same time, though.
Okay, so if it doesn't hit the lower band, we don't have an entry there then? Because we need it to come off the lower band?
So after this pullback, so what it says on here, ideally it hits the opposite band. It's not mandatory.
Okay.
But you look at enough of these, you're probably getting, you're best off if it does.
Okay.
But and Roman, the answer I always give people, and they hate when I do it, but it makes sense, is go find 20 examples where it hit the lower band and came off it, and find 20 examples where it didn't, and watch what your results are.
Yeah, I love when you give that response.
I know you hate it, huh? But
No,
but in all seriousness, because you really need to, because that will help you see stuff.
Right.
Because when you do that, there's other stuff that, and really you don't want to do 20, you want to do more like 50.
Okay.
Because when you do that, you'll start to see other things on the chart. And that's my intent for getting you to do it. It's not because I'm trying to be, to keep all the answers to myself. And I'm not trying to be rude and, being selfish or whatever, and not sharing what I know. What I know is that if you go take the time and do it, you'll learn so much more than if I just say yes or no.
Right. Okay, cool.
Is that cool?
Thank you. Yeah.
You're welcome. You're welcome. All right. Got that. You look at something real quick. Just got a text. Oh, I love it. Somebody called me on this. So Roman, I said, go find 20. I said, no, make it 50. Somebody sent a note, said, dude, you used to say 100. What happened to 100? So Roman, just because, I don't want to be considered, weak. So Roman, for you, you can't find 50. You got to go find 100. And everybody else, go find 100 of them too. And the reason for that is, in all seriousness, when you look at that many charts, it starts to fall into place. And all this is literally an exercise in grinding. People go, I want the shortcut. I hope there's no kids online because I'm about to use the MF word. Like, motherfucker, you've got the shortcut. Shit, to get there in 5 years, it can't get any fucking easier than that. It took me 20. And I'm giving you stuff that'll get you there in 5. You can't get there in 1 year. In fact, if you're in, well, let me ask you this. I'll give you this as an idea. I've got a guy that is a great doctor. He's really smart. He graduated high school about 4 weeks ago, and he was so fast in going through college and med school. He went through a med school in some third world backward country that he's got a medical degree, and he would love to do surgery on you. But man, it's cool because he went through it really fast. He knows what the fuck he's doing. You want to give him a knife and let him operate on you? And you all are laughing, going, I never would do that. Well, then why would you do it with your money? You've got the shortcut in this book. You can't shortcut a shortcut. You still got to put in the time. All right, where are we? So when we're doing the trades, This sounds weird. We're not doing the trades to make money. And you go, wait. My goal in class 1 was to make a boatload of money. Like, no, it's not. Your goal is to get to freedom so that you can do whatever it is that you want to do at freedom, or whatever you put down as your goal. But you cannot make your goal a money amount, because when this gets frustrating, that money won't be as appealing anymore. The money won't make you cry. It's got to be something beyond that. Because what happens is, if you focus on your account balance, I guarantee you're going to screw this up because your emotions get in the way. Right? Your goal is to trade well. And if you trade well, ultimately you'll end up reaching that goal or dream that you wrote on page 1 from 2 weeks ago. And the way you measure trading well is by it being a brick. And the definition of a brick is a proper entry with an intelligent exit that is done according to plan. And in that definition of a brick, there's no mention about a gain or a loss. There's no mention about the size of the gain or size of the loss. The brick has no value, no dollar value. A brick is just a brick, and it looks like every other brick that comes out of a factory. And all your trades should look alike. All your trades have a proper entry, they have an intelligent exit, and you executed them according to your plan. And then you pile up the bricks. Early on, you're gonna not make bricks because you unintentionally will break rules. That's cool. You don't, if all your trades worked out of the gate, man, it's horrible. You're not going to learn anything. You got to make mistakes. That's how you got to fail forward. And I'm okay with you making mistakes, not purposeful ones. Yeah, you did something because you didn't realize you missed a rule. Cool. That's how you learn. You're going to learn from that. And you're also going to screw up early on because of your emotions. You're going to want to stay longer. Oh, I can get richer. Oh, this will come back. Even though I'm losing my ass on the trade, I know it's going to come back. No, you just know that you're afraid to admit you're wrong, right? It's not about getting it back. It's about looking in the mirror and saying, it's not working. Man up. Close the trade. Woman up. Cowboy up. Whatever word you want to use. As you gain experience, you're going to find that the reason you don't make bricks is because of your emotions. And you're going to behave like a 12-year-old prepubescent teenage girl. Your emotion going to be all over the map. Happy one day, upset 10 minutes later. Everything's great. The world's going to end. And that's how you're going to behave. And it's going to take a while to recognize that. And then you got to learn to fix it. You got to learn to scrub it. You got to learn to address it, scrub it, and fix it. And then your challenge is not about making a ton of money. Your challenge is to make as many consecutive bricks as you can. Brick after brick after brick after brick after brick. If you do that, most of the bricks will end up being winners. You're going to have some losers in there. That's fine. You got to be comfortable with that. Brick after brick after brick. You think, well, wait a minute. Does everyone do it that? What about sports? Well, let me ask you this. What's his name? Brady won the Super Bowl last weekend. I don't remember what his completion was, but I know every pass that he threw was not a completion, right? There were some passes that were dropped. Did he sit there and cry about it and stomp his feet? Grab his cheetah pillow and sit and, curl up in a ball and cry and bitch about it? No. Went back in the huddle, did another play. LeBron playing for the Lakers doesn't make every free throw. He doesn't make every shot. He knows that's going to happen. Misses it? Cool. Go get the next one. If you've got a job in sales, when you go out on every sales call, you're not going to get a close on every one of them. Doesn't matter. You do it again. You do it again. You do it again. If you're the counter clerk at McDonald's, somebody walks up and says, I'd like a Big Mac and fries, or I want a Big Mac and a soda. They say, do you want fries with that? They're doing an upsell. Sometimes someone says yes. Sometimes they say no. The counter person doesn't sit and cry when the person turns them down because they don't buy French fries. They go on and ask the next person. That's how you have to be about trading, right? Most of your trades are going to work. Some of them it won't. That's fine. Just keep moving on. in removing the emotions on trading or money. I don't care how you say the words, what emphasis you put on what word. The objective is to make a brick. It doesn't matter if you say, I will make a brick, or 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 I will make a brick. I don't care. The result's the same. You just make a brick. There's a story I tell on this. I won't take the time now. You can listen to it in the audio, but it's where, and I still have the shares. I get shares in a pre-IPO. I mean, now you see these SPACs, SPACs that are coming out. Did one of these back, and it's been 15, 20 years ago now. And I turned 40 grand into about $250,000 in about just a few months, and then gave it all back because I had visions that thing was going to be a $3 million trade. And all it was is I was caught up in the emotion of money. I tell the long story there. And it should have been about making a brick. Make a brick, make a brick, make a brick. And you're going to find you will have a trade every now and then that will skyrocket to the roof, to the moon. And you'll want to stay in longer. Because it would, say you buy a stock at, 30, and suddenly next thing you know, it's at 70. And you listen to the scuttlebutt and go, oh man, this thing is going to 100. And it goes to 75 and 78, and then it goes back to 75 and 72 and 68. And then boom, it gaps down to 40. And you'll be kicking yourself that you didn't close it back at 68, 70, 75, because you had your sights set on 100, because you were doing the math going, wow, look what I could buy when this thing gets to 100. It's going to happen to you. And hopefully it only happens once. And the next time when you get the next parabolic move is you realize you close it, take the profit. You can always get back in. Right? So this is not about the money. This is about making the brick, executing the trade properly. Let me read the questions real quick. We'll keep right on going. Natalie asks, aside from gaining confidence that the trade is going in my direction, is there's another reason I should be looking at the smaller charts for a precise entry? Is it more of an exercise? Natalie, the reason you want to look at a smaller chart is early on, your objective is to get a buck on the option, $1.50, and get out. And if you'll do that off the smaller time frames, it's much easier. If you do it only on the daily and the 233, depending on the price of the stock, it can easily move $1.50 against you right away. And if you're in the trade, you got in right then, suddenly you got, wait a minute, and you might have had a perfect entry, but having that small of a price target is you're going to get shaken out a lot. But if you'll drop down to a smaller time frame, now when you look to get in there as that, for example, as the 21-minute chart is giving it setup on a bullish move, so it'd be coming off the lower band rising, it's usually very easy to be able to get that for $1.50 or so. And that's why you want to look to use the precision entry when you're new. It builds your confidence and it helps you read charts better. So that's the reason why I do it. It's not so much of an exercise, it's really to help you. Hopefully that helps make sense.
Chris, I have a question.
Yeah, what you got?
So on the trading account, and taking into consideration what you just said about a skyrocket, have you ever scaled out of a trade? So let's say it skyrockets, say it's
Yes.
a 3-bagger. Have you ever taken half of it off so you're back down, and do you take a second look at the charts at that point? And if it looks
Yes.
like it's going to continue to run?
So Troy, that's called, I'll cover that. You're in Fast Track. I'll cover that in a couple months in Fast Track. It's called the emotional pressure of profits, EPOP. It's the emotional pressure of profits. And there's a couple of different strategies you can use to take some off the table.
All right, thank you.
No problem. Good question. Let's see. I've never heard you use this metaphor, but might be worth using. I think of you as a master craftsman. I'm your apprentice. If you're a master craftsman, a furniture maker, you have me start by hauling lumber, then cutting lumber, then sanding, then joining. It takes me years under your guidance before I'm able to make an equally beautiful piece of furniture. John, that's exactly it. And so the cool thing is, you don't have to go through all of the learning curve that I did to get this, because you got somebody telling you, here's how you get there quicker. And what happens is mentally, a lot of people go, okay, well, he's telling me here's how I get there quicker. And even though I don't know what the fuck I'm doing, I think I'm going to even shortcut that. And when you think about that, that's really, not only is it stupid, it's really arrogant, because you don't know what it takes to get there. Why would you try and shortcut something when you don't know what it takes to get there? You don't know what you're going to miss along the way. And there's no reason for, if I can let you get there in 6 months, knew how to get you there in 6 months, man, I would do it. I'd probably charge you a little bit more, but I would be thrilled to get you there in 6 months. But it can't be done. And so you got to understand there's stuff that you learn along the way. And by trying to shortcut, you're going to miss that learning opportunity. Easy example on that, real life. You know, you'll see, you hear these kids that, you know, graduate high school, you know, they do homeschooling, whatever, and they graduate high school at 14 or 15, and then they go to college when they're 15 or 16. And it's awesome that they have the book smarts to be able to do what they're doing. But more often than not, their social skills are way underdeveloped. And so at some point, they need to almost take a step back and let their social behavior, if that's the right way to say it, catch up to their what their grade level is in their brain. Because you find that, and again, there's always, you can look at me, look at people and go, well, this guy's an exception. We can always find exceptions to anything. But generally speaking, you'll find when people jump ahead like that, they're missing other pieces that come along with the development. And so when you try in trading, when you try and shortcut stuff, I promise you there's going to be stuff that you miss in the development. And what happens is when you discover that you missed it, you don't just get to go back and reread that page in the manual. You got to go back and repeat that whole year in school, because there's things that go along with that that now add into what you're doing in grade 3 and grade 4 and grade 5. But if you try and jump from 2nd grade to 7th grade by doing some shortcut, you're going to miss all that other stuff that you would have learned in grades 3 through 6. So just, I think Luke said it in the last class. He said, man, I kept trying to do different than what he said. And when he finally started listening, I mean, he would say he was listening, but when he finally started doing what I was telling him to do, it came right into place. Luke, are you on, or did you walk away? See if he comes on here. I show him was on there. Hey, Luke, are you there? He's probably out grilling a steak. Jonathan, shoot a text to him. Say Hanson just called on you. When he comes back, he can come back in. But the point of this, don't try and do a shortcut. It's not going to help you. You've got the shortcut in front of you. To be able to get to freedom in 5 years is unheard of. And you guys want to get there in 2.5 weeks, 2.5 years. Ain't going to happen. Okay, there's stuff you learn along the way. All right, looking at your chart, you got a Lexion. We had this chart up before. On the left side, I've got the data brick. You can see I circled everything. And I put the cursor on the far right edge. And you can see now the values in each one of those. So if you look in that data brick, you see the date that I've got highlighted there is October the 8th. Yep, October 8th. Times 9, it's the 233 candle. So this is the candle that starts at 9:30 in the morning. These are all Eastern times. The opening price on that candle was 118. It rose up 8 cents at some point after the open, 118.08. It got as low as 115.05, and it closed at 115.5, rounding. Okay, don't worry about CSR or bars or the bar 1X. Don't worry about that. The next thing, it says BB21 up. That's Bollinger Band with a measurement of 21 and 2. So 21 period, or 21, what's the word I'm looking for? The 21 average, 2 standard deviations. So that's what that shortcut means. The upper band value is 119.60 something. And if you look on the chart, you can see, oh yeah, look at that. It shows what it is. The low is the lower band value. And you can see that's down at 110 and change, almost 111. And then the BB21,2 BA is the basis line. That's basically the middle Bollinger Band. And you can see its value is 115 and change. The next line says moving average 200, MA 200. And you can see that's the value of the move of the 200 MA at that date on the chart. And you can see its value is 101.92. And then you got the 50 MA at 112.5, right? And that's the orange line. It's a little bit hidden under that red circle, but that's the value there. And then underneath that, I've got plus DI and minus DI. And those are the values of the direction movement indicators, the very bottom indicator. You can see the plus line is at 26.85 and the minus is at 35.94, which says then the plus line is the red one, the minus is the green one. And you can see then that by that point that they've crossed, and you can see it on the chart that they've crossed. So at this point in time, I've got a cross in price. I've got a cross in Stoke. That's what I'm pointing at here. So I got a cross in price, got a cross in Stoke. I've got them crossing MACD. You can see the histogram. See, before it was a positive histogram. Now it's on the underside of the valley side. So at a mountain or a peak at a valley. I've got the valley on the 0 line here, on the basis line of the histogram. And I've got the directionals crossing as well. So this is a 3X. I guess you can call it a 4X, but it's a 3X, right? 3 of the indicators cross. One of them have to be MACD. And if I get 4 rather than 3, cool. Doesn't matter. It doesn't make it that much better. I want to have at least 3, right? And one has to be MACD. And why do I want it to be MACD? Because I told you, and because I love MACD. It's a great indicator for what I want to do. Okay. Now I can also go look at the daily chart at this point, and I can see at this point there, again, all the indicators are crossing, right? So I've got crossing here on price, here on Stoke, on MACD, and on the directionals. Awesome. At that point, now I go look at the weekly. Now understand, when I look at the 233, which was my entry, I can't tell what day of the week this is just by looking at it. Or on a live chart, I can look and see, because I can look and I can move the cursor back to the left to see where I start to see a jump in dates, right? It'll go from here from October 8th. If I can move left, it'll be October 7th. If the 7th were a Monday, my next candle would then show October 4th, right? Because I'm closed on October 5, Saturday, and October 6, Sunday. October 7 would be Monday. The 8th would be Tuesday, if that's what this was on this chart. But I can't tell from this point, at least on the printed page that I've got here. And so understand, I don't know exactly what the weekly chart looked like at that time. I don't know if that trade was taken on a Thursday, meaning 4 out of the 5 days had painted, or if it was on a Monday morning. I can't tell. And so at this point, I don't know how close to this diagram the weekly actually looked. But at the close of the week, you can see it's crossing, crossing, crossing. So this thing was poised to go. Again, I don't know how close to that Friday my entry candle was. And now when I see that 3X on the 233, now if I want to do a more precise entry, taking a precision entry, I go to the smaller charts. Now, if I go back and read in the manual, it says when I see a 3X on the 233, I go to the 13-minute chart, and we see the 3X showed up in the morning on October 8th. So I drop down to a 13-minute chart. And over here on the upper left is what it looked like at my entry. So this is October 8th. And you can see at that point, remember, I'm looking for an entry to go down. And if I had the data break shifted, I promise you there's not an entry to go down. And so what I'm watching for, remember the definition of looking for a pullback. I want to see price go. This was a bearish entry. So I want to see price on the 13 hit the upper band. All right. So I just followed along with fingers. No, 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 no. Oh, there it did there. And it pulled back. Right. So now it's coming back down. I can see it crossed here. Stoke crossed, but MACD never did. And then it just went sideways. Like, cool. That's not what I'm looking for. So I got to sit on my hands some more. And I watch and say, okay, let's see if it'll go back and hit that upper band and give me a potential entry. Nothing, 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 nothing. 2 days later, there it is. Outside the bands. What happens when price is outside the bands again? It can't breathe. And so it has to come back inside the bands. So it comes back inside the bands. I get price crossing right here, Stoke, and there's MACD. There's 3 of my 4. Boom, there's my entry. So I'm in there somewhere in the 112 range, 112 and a half, whatever it is, right? And I'm taking this trade down, so I'm buying a put. And then my exit, remember I want to take $1.50 and be gone. So if I'm in at about 112, 112 and a half, I'm getting out in the range of 111, whatever that number is. When it gets down there, close the trade and be done. Here's an example of a bullish setup. It's a different stock. This is Holly Frontier. It's an oil stock. And you can see right here, I know that it's on the 233 and I know the company name because it tells me right here. Okay, HFC, 233 time frame, Holly Frontier. And I look here and I say, oh, there it is, crossing. You can see that's crossing. If you're a veteran student or advanced student, you see this is divergence. You can see I get divergence here on MACD, but I can see MACD crossing. If you're a new person, don't worry about divergence. I'll explain it later. And I've got this kicking up from a low and crossing. Perfect. So my signal there is at about 41.37, call it 41 and a half, just to make the numbers easy. You can remember it. What did the daily look like at that point? Well, daily's about to cross here, right? Looks like I've got divergence here, got MACD crossing, looking fine. What does the weekly look like? Well, here's the weekly, coming down, hitting the band, spreading the band, just coming off the band. Hasn't told me it's going up yet, right? Red and green haven't crossed north. Stoke starting to lift, MACD hasn't crossed north. So at this point, I'm still in a downtrend. I'm probably near the end of this move down, but if I take this trade up, I'm getting in, I'm catching the corner. I'm getting in before the trend has told me that it's going up. I'm still, look at the size of the histogram bars here. They're starting to shrink right here, but I'm still definitely in a downward trend. So if I take this trade, I don't expect it to run all the way up to here, right? Because I'm going against the trend. Right here was my entry point. This is back to the 233. You can see I got in, it pulled back a little bit here, and then it took off going. If my plan when I first got in the trade was to get out, remember I said on the exit rules, you can get out when the 2 and 3 cross going against you. If that was your plan before getting in, then you would have got shaken out right here. If your plan said, I'm going to get out when, when price goes down and maybe fills the gap, I'll teach you that a little bit later, then you didn't have to sit and worry about it. If you waited for a precision entry, you didn't get in here, you probably got in here somewhere. And so you missed the anxiety of sitting through this pullback. And now it runs up. If your profit target was the 50 MA, you got out here. If it was the upper band, you got out here. It kissed it, you're done. That price point there is about 44. You're in at about 41 and a half. What's that? $2.50 on 41? That's about a 5% move. 1, 3, 4, 5, 6, 7, 8. Look, about 8, 10 days. 2 weeks, less than that, 5%. Right, on the stock. What would that have been on the option? 5%? Yeah, anywhere between 20 and 30% would be my guess. Depends how volatile it was. If we were doing an income account trade, right? Remember I said you want to have 20 to 30 times your gross monthly income. Let me just give you some numbers on this. If you had, let's say you're making 100 grand a year. If you make more, scale it up. If you make less, scale it down. 100 grand a year is 8,000 a month. 8,000 times 33 is $250,000. So if you had $250,000 and you had a $41 stock, that would have bought you about 6,000 shares. 6,000 shares moving up about $2.50. That'd have been about a $15,000 a week. You go back to cash, you're done. And go look for the next victim. Okay, that's all we're doing. Somebody have a question? I could hear some rumbling there. Cool, I'll keep going.
Doesn't go on us. Get us the kids. How come there's bubbles up right here?
Oh, you have to do double layer.
Hey, Judy, go ahead and hit
The kids
for me.
do one and it comes up.
Oh, sorry.
That's all right. No problem. Thank you. If you had done this as a daily entry, right? So you'd have got in here at about 41.5-ish, whatever that price point is, off the daily chart. You'll see that red and the green never crossed here. Right there, that wick, that on the 233 is where it hit the upper band. On your daily trade, you might have got shaken out here, right? As the red and the green cross going against you, you'd had a small gain. If you're willing to sit through that, because MACD never crossed back down. This is, again, it takes a while to recognize all these signals. But as MACD started to cross down, as it headed up, you could have got out up here as it hit the upper band. Any one of these 3 or 4 candles right in there, you'd have been fine. If you did that, you got out in the range of about 45. So in at about 41.5, out at 45, you made $3.50. It's about a 7% return on your money, ballpark. Right? If you had done that with that same $6,000 share trade, that'd have been about a $21,000 gain off a $250,000. Wait, is that right? 6,000 shares times 3, 18. Yeah, ballpark 20 grand, something like that. Right? If you had a $600 income account, no problem. Right? Then it'd been let's say you had a $6,000 or $4,000 income account. Right? So you buy 100 shares. It moved $3.50. You make $350. It's the same percent return. The only difference is the size of the trade. It's the number of zeros you have on the trade. But it's the same ROI. Some of you freak out going, oh my God, you could make 20 grand in a couple of weeks. It's like, you can make $350 in a couple of weeks. It's the same trade. It just depends what your experience level is and how comfortable you are with the method and how much you trust yourself to be able to push the bigger dollars onto this. And you just grow into it. And remember what we said about the weekly, you're going against the trend. There was your exit there. That's where it hit the upper band on the daily. Right there, that was the 50 MA on the 233. And you learn to be able to look at these and go, wow, I know how to translate them back because I'm so used to reading charts. I can tell you what did what on what time frame. Then we look at other charts. This is Apple. 10 years ago, Apple peaked out at about a little over, I think it was $704 back in mid-September of 2012. Yeah, that's 10 years ago. That's amazing. That doesn't seem nearly that long ago. And when Apple started to decline, you can see this on the daily chart. It gave a bearish signal when the price was at $690 and it peaked out at $704. People hear and they go, whoa, that's a $14 move. My God, yeah, that's $14. Well, drop the last zero. So it was $704 stock. That's really the same as a $70.40 stock. And it flashed an entry at 69.07. So it's really, it flashed an entry at 69. So it pulled back $1.40. That's 2%, right? Off of the high. And then it gave you a signal that it's coming down. And you can see it right here. Crossing on the daily on price. I've got divergence here for those that are veteran students and can see that. I've got it crossing on Stoke. I got it crossing on MACD. Interesting. And then what did it do from there? Well, we also, by the way, you want to look and see what was the weekly telling us. Weekly was running up. A couple of days later, it got down to 667. Still was heading up as we were looking to get in the trade. We'd be going against the trend, but this is getting tired. And we've been running up for quite a while. How far did Apple come down? This is the weekly chart. Here was your entry. Up there, what I say, about 690. Came all the way down. You could have got out down here somewhere, right? If you're just trading, not trading this off the weekly, but just reading this chart. Would have been a reasonable spot to exit down here. Looks like is at about 500. That's like taking a stock from 69 to 50, right? $19 on that. Depending how you measure it, that's a 38% return, right? But now here's what's interesting. Remember I said you can, this is why I love MACD. Notice MACD crossed here. Now notice MACD never crossed again until we got all the way down here. And look what price did. Price lifted up a little bit here, came down, 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 down. Right? It's very interesting how MACD gives you a great indication how it's going to perform. But if you'd have gotten out here at about 500, give or take, it might have given you another signal to get in again and take it down further. You probably would get tired of waiting through this area, not sat through that. My guess is you probably got another entry on that wick to take it down even further. Would have gotten out down here somewhere, probably wouldn't mess with it at this point. And you've gotten most of it. And now look what it's doing. Bounced off the 200, signaling to go back up at about 450. This is on a weekly chart, not something how I trade, but you see what that is. Stock signaled at 690, got as low as 385. It's a 300-point potential move. You're not going to get all 300. Right? Even if you got out to here, you got 190 to the 300. You're not going to complain. That's thrilling. Go find the next victim. This is Baidu. If you're not familiar with Baidu, think of Baidu as like the Chinese Google, is the way I would think about it. Entry here on the 233. This is mid-December of 2012. Yep, 2012. Did this trade for client money way back when. Entry there about 91.5. Signaling, signaling, signaling. Daily chart, poised to go. We've got divergence, crossing, crossing, crossing. Entry there, 91.5, 92, somewhere in that range. Weekly at the time was bouncing off the 200, tired, poised to go up. This is catching a corner. Here was the entry. I covered up MACD a little bit inadvertently, but just watching price, could have got out right up here. What's that, about 102, 103, something like that. In at about 91, 92, out at about 102, ballpark $10, ballpark 10% on the stock. Took about 2 weeks. Right? It kept running. Don't need to get all of it. Just take a chunk, totally fine. If you wanted to go for a more precision entry off this, this is the 233 that we showed before. At this point now, I'm going to use the 13-minute chart looking for precision entry. Reading off what it says in the manual. I'm watching for price to hit the lower band, the opposite band, and then come off and give me a signal. And see, it didn't happen. Nowhere here does it hit the lower band up until this point. It hit the band here, came off, everything signaled, crossing, crossing, crossing. There's my entry, and there's somewhere about, was that 96, 96.5, something like that. And then I take it to its appropriate exit. If I stayed in as long as the thing saying you get out at like 102, then you'd have had $5-6 on a $95, ballpark 5%. Totally fine. Right? If you wanted to take it for just $1, $1.50 on the stock, you got that within maybe an hour, it looks like. You can call it done. Chunk in the middle, perfect. Proper entry, intelligent exit, done to plan. Throw the brick on the pile, go find the next victim. Be the cheetah, go back in the grass, sit and wait for the next the herd of wild animals to come down, and just decide, do you feel like eating an impala today? You want to eat a gazelle? Right? Wildebeest? Hyenas are pretty chewy, so they say. Warthogs are good. I've had some of that. Maybe you want to eat that. It's totally up to you. Whatever shows up. And by the way, the cheetah doesn't really get a choice if you think about it, because it doesn't know if the warthogs are going to show up to the watering hole. Today, it might just be the herd of gazelle. Well, guess what? Then he's going to eat a gazelle that day. That also means that if you, when you're looking for trades, if your favorite stock of all time is Apple, you don't just sit there and wait for Apple to show up. You trade what the market gives you. You may not see a trade on Apple for months. And if you're sitting there waiting for Apple because you're jonesing for Apple and you just love the Apple products, you want to own it, you're an idiot. Nothing against Apple. You trade what's out there. And if it happens to be that the tech stocks are not setting up and you have to trade oil, then go make some oil money. If it's Chinese internet that's showing up, then go hit the Chinese internets for some money. Right? You never want to get, you don't have a favorite stock. Your favorite stock is the one that is setting up and is about to make you money and that you're going to victimize. That's your favorite stock. Okay, it's all about being a predator. Hey, now that I think about that, that's where that comes from, because there's a news guy named Chris Hansen who had this TV show about To Catch a Predator, right? And he was out looking for the sexual deviants that were, chasing the young kids. We're taking the same approach. We're not chasing young kids. Don't get the wrong idea. We're just looking to be a predator and hit the stock market. And our victim is the market maker. That's who our opponent is, right? And we're just acting like the predator. We're going to go get the market maker and school him, take his money.
Hey, Chris, I have a question about the precision entry. Hello?
Yes, go ahead. I'm listening.
Okay. So, like, you start on the 233 and then you go down to the 13, but then, like, that 13 minute chart, their entry doesn't occur till like 2 days later.
Correct.
So are we, I mean, this is a 13-minute chart. So are we supposed to be like glued to this thing over the 2 days?
So yes and no. So no, you're not going to sit there every 13 minutes and watch it. But Dana, great question. So what you can do, so let's say that you're, where's my cursor? Let's say that your signal was right here on the 233, but now we're looking at a 13-minute chart and you're waiting for that 13-minute chart to pull back, right?
Uh-huh.
So just, and you're a numbers guy, so you can do this quick. You can do this quick. So there are ballpark 5 13-minute candles in an hour, correct? Because if it were 12 minutes, that'd be an hour. So ballpark 5 of them. Right?
Yes.
And after you study this a little bit, you'll realize it probably takes at least 3 or 4 candles for it to go from upper band to lower band and then come off the band. Mm-hmm. So you know that you don't need to look at it for the first hour in the morning. Right? And Dana, you're on the East Coast, so 9:30, so you don't have to look at this thing till 10:30. And when you look at it, all you do is you pull up the 13-minute chart and you're going to look right at this point, right? 3, 4, 5 candles in. So it's going to look something like this. And right then, this is nowhere close to the lower band, right?
Yeah.
So you just look at it and go, I don't need to look at this for another hour. So you put, you become very Pavlovian. Whenever you hear the bell ring, you start salivating, go look at your charts. And you're going to set an alarm in an hour. And that says, okay, now you looked at 10:30. We're going to go back and check it out about 11:30. And you check it out about 11:30 and it's looking right here. That also is nowhere close to the lower band. And that takes you literally 5 seconds to see that. And I don't care what kind of job you've got, unless you're doing surgery, right? Where you literally are elbows deep in somebody's torso, you can do this. Right? The only other person that can't, there's a guy, I can't remember if he's on the call today or not. Is he on there? I don't see him. Not this time. He's on other times. He's a pilot and he flies Gulfstreams. So he flies the little private jets. He's a corporate pilot. And so I get pictures from him every now and then, like, oh, here's the shot of the sunset over Fort Lauderdale. And he lives in Vegas and he flies all around the country. When he's up in the air like that, he can't be watching a 13-minute chart. At least he's not supposed to be. And so he's the one guy that I would give an excuse or a pass to say, okay, you probably don't want to be doing that. You got to pay attention to what's going on. There's another guy doing the class. He hasn't been here in a while, but he's a fire captain, LA Fire. He was managing the, what's the word I'm looking for? The CAL FIRE guys and some of the prison workers that would go. And so when you're in California, we get brush fires all the time. They go out and one of the perks of being, sorry, it doesn't sound right. If you're a prisoner, one of the perks you get if you behave properly is you get to go out and dig trenches and fire lines. which doesn't really sound that appealing to me, but I guess if I were in prison, that would probably be pretty appealing. And so this guy was managing that group of people. And so when there would be these brush fires going on, I'd get a call from him. He goes, hey, I'm not going to be in for a few days. I'm driving up to Yosemite. I'll be living in a tent for about a week fighting the fire. When he's there, he can't be checking the charts, right? He barely has access to water and food, let alone, the internet and Wi-Fi. So that guy would give a break too. But the rest of you, I don't care how busy your day is, you can look at for 5 seconds on the chart and say if that's hitting the band or not. If it's not, in an hour to check. So Dana, you're going to check this thing maybe 4 or 5 times during the day, and each one's going to take you maybe 10 seconds. Like, okay, it's not there. Tomorrow doing the same thing. Now we're here. Tomorrow doing the same thing. Now we're here. Your total amount of time looking at the market during the market has been less than a minute in these 3-4 days. And now you see it here and it's starting to come down. You look there and you go, oh, maybe I should check this again. You check, it's getting close. The next, oh, look at that. It opened up outside the bands, right? On this big white candle that bounced off the 50, the orange line. Oh, I'm going to have to check it in maybe 2 candles. So you set your alarm and in 26 minutes, you come back and look. Oh, it's not there. Set it again, come back and check it in 15 minutes, right? Oh, there it is. Press the button with the broker, you're done. But each one of these checks literally takes you about 10 seconds. And you can do it from your phone in the middle of a meeting. There are tools you can use. One of them is called Team Viewer by Microsoft. Google has one as well, and I can never remember the name of it. I know somebody will interrupt me when I'm done and tell me what it is. But they have a tool where you can leave your trading system on at home, and through your phone, you can access your trading system. You just have to swipe through the screens to get to the monitor that you want to. You don't want to do your homework this way, but it's an easy way to go in and check the 13-minute chart to see yes or no, is it there? And if it is, then you go to, hold on one second, then you go to your broker page and you can place an order from the phone. If you're in a meeting, I see you guys checking Facebook all the time. Just pretend you're checking Facebook like all your friends, or step into the men's room, or step out with the guys that go out and smoke a cigarette and go out there. And with COVID, hell, you're sitting staring at your computer screen anyway. It's easy to do. Dana, does that make sense?
Yes.
Cool. Cool. Luke, are you back on? Still grilling a steak.
Hey, Chris.
Well,
Yeah, go ahead.
Chris,
Gail, go ahead. What you got?
Stop it, man. It's Alex.
Oh, sorry.
Hey, there's a good Trading View is a good app. I don't know if it's for iOS, and you can set up a chart, any indicators. You can customize it all.
Yes, correct.
Yeah, it's a great app for just checking a chart real quick.
Very cool.
All right.
Very cool. Gail, you had a question?
Yes, regarding the Bollinger Band, I have to think of the champagne every time. It looks like it swell like a stomach ache, and then it shrink back like a whale. I don't know how to, if it's...
So what that is, I think it was a chemistry beaker. Right, so it swells up here, and then they come close together. Then it swells, and it comes close together.
Yeah.
Right? So it looks like a. I think it's called a beaker. I never took chemistry, but I think that's what it is. Gail, what that is, that's showing volatility. And so whenever you see here, I'll see if I find a better example of it.
Because I'm seeing it on a lot of time when there's the 3X.
Yes, exactly, and that's when I want to see it. So when the bands are wide apart, that tells me it's been volatile. When the bands are close together, you'll see that price has just been going sideways. So Gail, see right here, see how price isn't moving very much? There's no volatility in this stretch. You can see my screen?
Yeah.
Right, now look what happens. See how the bands are starting to pinch together? They come together right there.
Yes.
And then all of a sudden the price gets volatile, right? It goes outside of what had been the prior range. And now the bands spread a little bit. And then it goes sideways again, and the bands start to come together. And then it's gone sideways here quite a bit. And now see how the bands are really tight? Mm-hmm. All that is the Bollinger Bands just visually give you a representation of how volatile the stock is.
Okay.
Is that what you're asking? I started talking,
Yeah.
and even let you finish your question, but I thought that's where you were going.
Yeah, no, that's what I was referring to. So,
Je suis très intelligente.
oui.
Et
J'ai vu
aussi
ça.
modeste.
Non, vous êtes très bien.
Oui.
Mais, so I guess once you have the 3X and the Bollinger Band are expanding, it's a sign that the volatility is happening, or we don't really
No,
put it
that's-
as one of the factors that
Exactly.
go into the trade.
No. You're right on there. So when you see when the price hits the band, and I haven't talked about this, but when the price hits the band and spreads the band, that means that it's pushing the recent volatility to be, I don't want to say this, not that it's expanding recent volatility. It's going outside of the range of the recent activity, which means that it's now more volatile, which causes those Bollinger Bands to spread. Because if you think of it if you go the math right, put your engineering hat on, what's happening is that the sample size that you've got now includes some items that are outside of the prior normal for the range. And that then causes those Bollinger Bands to spread apart, which is an indication visually that there's more volatility. And as it comes then off the band and starts to come back inside where there's air, the price tends to rocket back up because there's a lot of room for it to get to the opposite Bollinger Band.
Yeah. Okay, cool.
C'est très beau.
Merci.
So you guys are impressed that I can speak a little French. I can say it, but if she says anything back, I have no clue what she's saying back. So I just say oui and I move on. All right. Thank you, Gail.
Merci.
Let's see. Baidu, we covered this. All right, let's go on to this one. So the next thing we talk about here, this is the relationship between showing how candlesticks and Bollinger Bands interoperate. And so, Gail, in fact, I should have thought about that. We answered your question right on this next slide. So see right through here before the highlighted section, see how prices just going sideways? And look how tight the bands are. And then we had one day where price gapped up. Now, why did it gap? There was good news. Could it have been earnings? Could it have been that, Baidu found the cure for cancer? Who knows? Maybe somebody offered to buy Baidu, not likely because it's a Chinese firm, but likely was earnings. And so price gapped way up. See how the Bollinger Band spread? See that little kicking up there? And now when price was outside the bands, what does it do? It's got to come back inside. So it went sideways for a couple of days, then it started to decline. And then it started to lift, came back up. The 10-for-1 says they did a 10-for-1 stock split on the state. I'll explain that in class 3. And then price went again outside the bands. It opened up the next day again outside the bands and then rocketed back down. So it's an example of what happens when price goes outside the Bollinger Bands, comes back inside. Okay. And now thinking that, I'm sorry, go ahead.
Yeah, and it's always like that, right? If it goes outside, it always have to go back in within 2 candles.
It doesn't have to. No. It doesn't have to go back within 2. It could take longer, but you usually won't see it staying out there for very long. Usually, there's always exceptions. I can point an exceptions to you going on right now in the market. But generally speaking, it's not going to stay out there for a long extended period.
Perfect.
Okay, but remember, there's no quote unquote rule. There's always an exception to it. But your general expectation is when it's outside the bands, you look for it to come back in eventually.
Okay.
Are you seeing a 3X pattern there
On which one?
with Stoke and MACD?
Yeah, you can see it right here.
Right.
I guess you could see it here too.
And then the following, I mean, the Stoke and MACD seem to be lining up as well. Or am I reading too much into it?
You're just looking for a 3X. I mean, the answer is yes, you're right. There is a 3X here. I was pointing out the reason I found this that's jumped out at me was because it's an example of price being outside the bands, how it comes back in.
Right, the Bollinger Bands.
Outside
Right.
the bands and comes back in. But yeah, Dave, you're right. There is a 3X here on both of these.
Okay. Thank you.
You're welcome. Good eye. Hadn't seen that. I hadn't noticed that before. All right. So when we were talking about candle patterns, and I had you talking to yourself in the mirror, describing the, what is a falling three, a rising three, a bullish engulfing, a bearish engulfing, a doji, and all those. I left out two of them that were called tweezers. There's tweezer tops and tweezer bottoms. And the reason I left them out is because there's other elements in a chart that are required that I hadn't explained at that point in the class a few hours ago. So in looking at this, I can see right here, there's an example of a tweezer bottom. I've got it highlighted. And what you'll notice is price is coming down. It's on or about June 11th. And you'll see the red candle outside the bands. And then it's followed by a white candle that goes back inside the bands. And you'll see that the bottoms of those candles are basically the same. Just eyeballing it, they're pretty much the same. Again, if you got to get a micrometer, you're in the wrong industry. You just eyeball it, and if you're not sure, get up and walk to the other side of the room, put your butt against the wall, and now look at it from that distance. And if it looks like they're the same, then they're the same. Okay, and so when you see a tweezer bottom, you'll find that price tends to rocket going back the other way. And so that's another candle formation you'll see. And you can see there's one here also where you have a white, so here's a tweezer top, white candle followed by a red candle. But in a perfect world, I'd rather see that red candle body be much bigger. You see this one if it engulfs, it's even better, but at least this one is, I can't remember the term they use for it, but it went up about halfway on the candle. Much more attractive, or much more, my eye is drawn to that. If I turn the page, I've got an example of a tweezer top. And there you go. You see you've got a white candle followed by a red body candle with the tops being about the same as you eyeball it. And that in and of itself, there's things you can apply to that, but you've got to learn to read other elements on other charts. But the first starting point is to recognize, okay, this is a tweezer top, this is a tweezer bottom. And that points back to the earlier, like I said, the earlier pages in the candlestick section where I referred to that.
Hey, Chris, in the tweezer top or tweezer bottom, is it that you said that you prefer to see the second candle be large and preferably engulfing?
In a perfect world, John, yeah, I would. It doesn't always happen that way. But it's kind of like a prom queen. That would be like, whoa, that's Miss America, right? When you see the second candle engulfing.
Thank you.
But I'll settle for just a prom queen where it takes up, maybe half the candle body. Let me read a question quick. So John, you had a question. Stock price movement and option price movement are not perfectly correlated. That's very true. For the beginner strategy for exiting a trade, should we exit when the stock moves $1.50 or the option moves $1? And the answer is either one. So John, either one you want to do is fine. The idea is to get you used to, when I set that exit point at being $1.50 on the stock or $1 on the option, I'm not worried about you making $1. I'm not worried about the exit. I'm more, if you can get the entries correct, picking that kind of gain is not a problem. And if it ends up being a 95-cent gain or a 90-cent gain, that's fine too. I'm not worried about that. It's more so that if you can recognize to be able to grab $1.50 on the stock and can do that consistently, that shows me, and really, and that's not important, it shows you that you now can spot entries. Because getting a $1.50 on the stock is really simple when you have the proper entry. It's when you don't have the proper entry, you get very frustrated because they don't seem to show up and it's not working right. But if you wait for the proper entry, getting $1.50 on the stock, not a problem at all. And then once you build that confidence, you just do it again and again and again. I changed the manual. It used to be in the manual, I said your objective was to get 25 of those in a row. And so imagine that you get 25 winners in a row. People go, whoa, that's not possible. I go, yeah, it's possible. I have people that have had 30 and 40 in a row. But what happens is when I set that as the objective, I had set that for myself and it hit a number of times. But what had happened was I found that I was afraid to get into a trade because I didn't want to break my win streak. even though that trade would very likely work. And if I didn't have the pressure of the win streak to maintain, I'd have taken the trade, no question. But because I didn't want to have to go back and start over to say, well, I got to 23 and I lost one. Crap, I want bragging rights to say get to 25. There's no bragging rights on that. Who cares? And so I removed that I won't say requirement, but that suggestion from the manual. But getting a dozen in a row is not a big deal. Getting 15 in a row is not a big deal. And you'll find, you get 15 in a row, you'll have a loser, and then you'll be 15 out of 16. And it's funny, you'll be pissed that you had a single loser. And it's really strange because when you're starting, you've never done this, like 15 in a row, that's impossible. And that you got a guy that got 15 out of 16 and he is hopping mad. They didn't get that last one right. Right? I don't know if let me see if he's on the call today. I can't remember if he's in here or not. Hey, Nat, do me a favor, come off mute for a sec.
Can you hear me?
Yep, you're there. How many did you have? Yeah, what was your, how many did you have?
I got 17 in a row and missed on 18.
And then how many after that did you get?
I got another 15 in a row.
So look at that. So he got 17 and 15, so 32 out of 33. And he called me when he missed number 18. He was pissed. Yes?
Very pissed. I wanted my 25, man.
I understand. But you see the mentality on that. Nat, thank you very much. Right. Oh, by the way, Nat, before you come off mute, how long have you been doing this? When did you start?
Exactly a year ago.
So he's been at it for a year and now is able to do 30 in a row. Or, 30 out of 31, whatever that math is. Right. And he just sits there and he grinds on it. He had stretches where he was, going off a little bit on a tangent, get on the phone with me or another guy doing this and kind of get him squared away and doing it. And it literally is just a grind. And what allows him to grind is he wants the situation to change. Right? That's the driver to do it. It's not the drive to get 30 in a row. It's the drive to get to his why. Right? And he wants a different situation. For whatever reason he wants it, that's on him. Doesn't matter. But the point is that that's what keeps him sitting back in the chair and doing this stuff. That's what keeps him, having his head, he falls asleep on the keyboard sometimes, doing this. And it's the why that keeps him there. It's not making a buck. That's not relevant. It's not getting 30 out of 31. That's not relevant. It's the why that keeps him there. And that's why I say early on, your why has got to make you cry. It's got to keep you pushing at this when you get frustrated, when you're tired. Right? It is just a question of grinding.
Question for you. When you're doing a run of 25 or 30, you're making bullish trades and bearish trades through this. I'm assuming it's not I'm under, just my frame of mind is such that I'm thinking, oh, it's going up or it's going down and downward trend, but that doesn't necessarily mean that you couldn't work it both ways, obviously going through the trades that you're making, right?
Yeah, Dave, you can trade whatever direction you want. It makes the most sense to trade in the direction of the market. So
right. But all I'm saying is just by default, I'm assuming, oh, it's all going up or it's all going down, and it's probably it's a zigzag, I would imagine.
Well, think of it this way: when you go, you're going to go out to dinner. You get Valentine's Day, right? You're going to take your lovely bride out to dinner, or at least go get some to-go food. Right? Because you're not going to make her cook on Valentine's night while you're sitting here enjoying yourself with your feet up, listening to some clown talk about the stock market. So you're going to have to go out and get her a nice meal to go somewhere. Right? And when you walk into that restaurant and pay for it, are they going to say, hey, dude, sorry, we're not taking call money tonight. We only take put money.
Right. Got it.
Yeah,
got it.
Doesn't matter. And just be sure.
No, I understand. It's just my mindset trying to get over that.
Yeah, just you trade whatever the market's doing.
Yeah. Cool. Thank you.
You're welcome. Let me check a couple messages here they got, and let's see.
Hey, Chris, quick question.
Please.
So on the tweezer top example, if you look like about 6 candles back from that example, would you consider Yeah, would you consider that a tweezer top as well? Or would you consider that just like a long-legged, or I guess just like a...
Josh, I'd rather have it be a red. Yeah, Josh, I'd rather have it be a red body candle.
Okay. All right, thank you.
So Chris, if I understand the tweeter situation, you have to have a white candle and a red candle, or a red candle and a white candle?
Yes.
Always. But then what do you do with that tweezer?
So all the tweezers telling you that, hey, it's going to come back inside the bands. And at that point, with the expectation that that's going on, now you're not going to trade it necessarily on that time frame. But if you, like, for example, this is showing up on a daily chart, you could look to drop down a time frame and look to find an entry on a smaller time frame, because the daily tells you what it's going to be doing. Okay. And so now you look for an entry, and again, this is all about a brick, right? So I'm looking for a proper entry and intelligent exit according to plan. And I'm going to look for that on the smaller time frame. It could be on a 55, on this case, could be on a 55, a 34, wherever it may be. But I'm looking for it to move back inside the bands, because on the daily, it's outside the bands. And I want it to come back in.
Yeah, that's very cool. Now, a question for you. So let's say you have the 3X, everything is lining, the stars are aligned, and you want to do that break. But it's Friday. Do you do that option put or calls on the Friday, or do you wait for Monday?
So Gail, let me ask you this. Look where my cursor is. See him right here? See this red candle?
Mm-hmm.
What day of the week is that?
No idea.
Exactly. So when we go through and we study charts, you'll never hear me say, well, this is a Friday or a Monday.
But when I'm looking at chart, I'm looking at the day of what things are happening. So in this case, I would know which day I'm on.
So there will be times at, certain times of the year, as you get into the summer, for example, you'll find that and it happens almost every single August. The market gets slow, it just vibrates around, and we're driven by geopolitical stuff. So the clown in North Korea he'll rattle his saber, something will go on. The shit will go on in Iran, and that'll be going, the Mideast something will bubble there, right? Somebody somewhere in the world will bubble, and that'll cause the market to jump. And you'll find that there'll be periods of time, it happens every year, where we seem to be driven, and the market gets very gappy, and it's always on geopolitical stuff. And if people are feeling a little bit tense, and they don't know and especially with Trump there, right? Because you never knew what tweet was going to come off of his phone. And so you might be unwilling to hold over a weekend, right? Because you never knew which way the wind was going to blow. And so at that particular time of year, you may choose not to hold it over a weekend. And so it happens. But there's other times where the market's trending in one direction. Friday, Monday, it doesn't matter.
Okay. Perfect. Merci.
Cool. All right, let me keep going here. I had a question. Yeah, go ahead. Then last one, I got to read these texts, then we'll keep going. What you got?
On an intelligent exit, if I got in on a smaller time frame, am I watching that smaller time frame for the exit, or do I go back to when I spotted the 3X, maybe on the 233?
So good question. So let me go back and read what it says in the manual, because I want to be sure it's written there. I want to be sure it's written in my manual and yours, because I know it's in yours. I want to be sure it's in mine too, because mine is a copy of yours. Where is it? Here it says right here. Does it say this in your manual? After you've entered the trade, don't watch it on a smaller time frame. Analyze the 3X chart candle by candle basis and follow the exit rules. Is that sentence in your manual too?
It sure is. Thank you.
You're welcome. No problem. And I don't mean to be an ass. I want you to know where it is.
Oh, love it. Thanks.
Hey, Jeremy, what's really cool is if you hadn't asked that question, right, and you were kind of wondering, and then next time you go back and listen to the class, you'll be like, man, I didn't hear that the last time that he said it. And it's really interesting, you know, when you're ready to hear it, you'll hear it. And that's why you want to keep going through the class. Oh, that's right. That's why I make the price to retake so cheap, because I know you'll hear something next time through that I said the first time you heard it, and the second and the third time, your brain just wasn't ready to hear it. And there's nothing wrong with that, right? You're not at that level to understand it yet. But now once you've got the experience and can see it, and then you hear it, you're like, oh, cool, it's shit. And then you're like, crap, it's been there the whole time, right? But you just weren't ready to hear it yet, which is no problem.
And I just lived it because there was a gap and it turned on the smaller time frame, but the 233, all the indicators were still in favor of my direction.
Exactly. And the coolest thing on that, Jeremy, because you lived through it, you'll never forget it.
Mm-hmm.
Right? You may not, 6 months from now, you may not remember it was on ABC stock, but that lesson will stick. You won't know what ticker it was, but you'll never forget it. So the next question that comes up is, hey, the methodology seems pretty cool. How does it do around historic tops and historic bottoms? So this is the low of March of 09. And you can see back here the market bottom in the financial crisis. The S&P went down to 666. Kind of ironic that it did that if you understand a little bit about religious symbolism. And then a couple days later, it signaled, and it flashed a signal here at what was the close? 72.17. So the S&P was at 700. Oh, by the way, let me explain this real quick. The SPY is a representation of the S&P 500, and it is 1/10 the value. So where I've got my cursor here, you can see the closing price was at 72.17 on March 10th. And this is on a daily chart. If you go look at the S&P and see what it closed at on March 10th, you'll see that it closed at 721.70. And so the SPY and S&P relationship is a 10-to-1 or 1-to-10, depending how you're viewing it. So if the S&P is 3,000, then SPY will be 300. If the S&P is 1,000, SPY will be 100. Okay, it's a 10-to-1 relationship. And so this signal at entry here at 72.17. And then we've just been going up and up and up ever since. If I remember it, I think SPY today is like 330, 350. I can't remember what the number is, but it's north of 300, right? So that says that the market has risen basically 400% in 10 years, right? Or what do we got? 2009 to now, so almost 12 years, right? It's risen 400%. And this is one of the reasons I hammer on people comparing the difference between stock and real estate. Real estate has not gone up 400%. And you could have just bought this and held this and not done another goddamn thing. You could have rented it occasionally. You could have made in the range of about 1% a month. And it would be just like buying a fourplex or an apartment building that ran fourfold in 12 years. And that doesn't happen. And while you're collecting in the range of 1% a month in rent, you can't do that in real estate. And you never get a phone call to say, hey, come fix come fix something. Right? When people understand this, they're like, oh my God, look what's there. This is cool. Let me learn how to do it. Okay, so the method does catch the historic highs and lows. You see right on the chart there. 3x or cross, cross, cross. There's your 3x. You say, well, what did the weekly look like back then? Well, that to me looks like a tweezer, doesn't it? Outside the band, small red candle, big white one coming in. And you say, well, a tweezer, what does that tell me? It tells me it's going to go up. And boom, we ran from there. What about the Qs when we had the top of the .com? So this was March of 2000. I can't remember what this was. March of, I think it was 2000. Well, of course it is, because it says right there. Right there it is signaling to come down. Now, if you go back and look over time, something to be aware of is, because we're coming into this now, I don't know when, but it's getting closer. It's closer to ending than it is beginning. Market tops are always violent. Market bottoms are quiet. Let me give you an example. Go back and look here. This is the S&P, right? You're like, well, that moved quite a bit. That's actually pretty calm to when it had been. And then when you go look at the tops are always violent. So just keep that in mind. So when you see, if we start seeing a lot of churning where the market will make a new high and then come down and slam down, then go make a new high and churn around, that's the sign of topping action. If you want to know more about that, go read O'Neill's book, How to Make Money in Stocks, and go read the section about M equals market, and go read the section where he talks about market tops and market bottoms. And he shows lots of examples that have gone since like the 20s of tops and bottoms, and it'll give you a comfort level of what has happened before. And the market tends to repeat itself. It's very likely to happen again. So you can learn from the history on it. And people will say, well, no, but this time is different because we've got cloud computing and we've got this and we got that. That's great. We got humans that are in there, and humans behave the same way. Your ancestors a couple generations ago behaved the same way that you did. They might have been farmers, they might have been small merchants, but their hope and greed and fear was the same as what you have today. We're still the human animal. You hear me say, go get multiple monitors. And the reason why, this is a screenshot from my laptop. Now, based on what you've seen me show the last 6 hours, would you rather look at those size screens or these? This is what you see on a laptop. And you want to be able to see this on a full-size monitor. And whether you want to do this on a big screen TV or whether you want to do this on multiple monitors, I'll let you make that choice. I run on multiple monitors. There's a lot of people that are moving to TVs. I haven't done it yet, so I can't speak to it firsthand. I've heard a lot of people like it, and I've heard some people don't. They tell you it's harder on the eyes. But you go figure that out. Find someone if you can find someone that's doing both, find one and find the other. And if you can take a look at it and see what's most comfortable for you. I don't really care which route you go. I just don't want you to be doing this on a laptop. Go get multiple monitors. The place you can go to naplestech.com. The guy, www.naplestech.com. The guy's name is Len. Tell him you're in the class. He gives you a discount for being in the class. Tell him, he'll know you know me. Ask him to show you what I have, what I first bought. I'm trying to think. For about 15 years ago, I bought a 6-monitor system from him. I still have it sitting here beside me. The machine still works fine. And then I bought an 8-monitor system from him, 3, 4, 5 years ago. Excuse me, and then I bumped it up to 12. So I do run 12 monitors, but I'll never publicly admit it, even though I just did. I'll tell everybody that I run 8 because I don't want you guys freaking out thinking you need 12. The reason I use 12 is because if I day trade, I want to see more screens. But unless you're down to the level of day trading, if you get 6, you're going to be fine. 8, you'll love it.
Hey, Chris.
Hold on one sec. Dan, hold one sec. The reason I like going to Len is all he does is multiple monitors, and his support is phenomenal. If you got a question, you call him, he'll answer it. If you've got a question on something, call him, he'll step you through it. He's a very, very patient guy. And he finally decided, after all the people that were buying systems from him, and they were asking him, say, well, how you doing in the class? He's like, I want to do in the class. So he finally decided to join the class in January. So he's now sending me emails saying, well, what about? And so now I get to be a little bit harsh with him, saying, read the RTFM, RTFM, or RTFM. And he knows what that, if you don't know what that means, don't worry about it. A little crass. Ask Len what it means. He'll know what it means. Dane, go ahead. What you got?
Yeah, just real quick. If you're going to try to do a large screen instead of multiple monitors, make sure it's a computer monitor, not a TV. Otherwise, your screen refresh, your mouse jitter will be terrible. I tried both.
So you want to do a computer monitor, not a TV?
Correct.
Cool. Dane, what size do you use?
It's a 43-inch.
And do you have one or do you have multiples of them?
I have one. It's basically the same as 4 monitors as far as pixels.
Okay. And are you driving it with a laptop?
Yep. So okay. I use the laptop monitor as well.
Is that one of your 4?
No, that's the 5th.
Okay. Very cool. Very cool. Thank you for that.
Hey, Chris,
Yes,
it's Alex.
Hey, Alex.
Hey, I just wanted to say, I actually, sorry to contradict whoever was speaking last, but I actually run it on like 4K TVs and it works fine. So I'm not sure what the issue is, but maybe just check that. But yeah, I just run it on 4K TVs and everything's good.
Okay. Cool.
Yeah,
Like I said,
I
just
do
run
the
it on monitors. I can't speak to it.
Chris?
Yes.
Sorry, yeah, the 4K TV is very good. I run mine on a 55-inch and it works great.
Cool.
Yeah.
Very cool. So you hear both sides of it, right? And you go figure out which one is best for you. I don't know. I would ask Len. You know, hell, he's the guy that sells this stuff. Get his opinion on that. That's, you know, I love having that guy as a resource. And by the way, I don't make a dime from him in doing this. So you can go wherever you want, but I've had, I don't remember if I've ever had a complaint about him. It's been nothing but positive. I just got a couple texts from people saying, man, he's awesome. So you can go where you wish, but just, he knows what I do. Again, I'm not making a dime off of it. So I don't have some ulterior motive. I just love, and from a guy who used to sell PCs and know what a pain in the ass they are, it's really comical to me that here I am recommending that you go to this place for, you know, PCs. I used to I would just groan whenever a client would come and say, hey, we want to buy, you know, we need to buy 1,000 laptops or whatever it was for our employee base. Like, man, you know, it's great money, but God, what a pain in the neck. And so it's funny that here I am, I'm more than thrilled to refer somebody to them, and the product runs great. So get multiple monitors if you don't have them. Somebody say something.
Yeah, Chris, I have a tweet at the bottom question on page 127. I think on June 3rd, if you look at that date right there, those 2 red candles, would that be considered a tweezer bottom also?
Tony, what page are you looking at?
127.
I got my pages numbered different than you do.
So the tweezer bottom example page.
Oh, got it. Okay. This one?
Yep.
And what?
No. Yeah, that's the one. So if you look at the 2 left candles, the 2 red candles to the left of the example, would that be considered tweezer bottom also?
You're talking right here?
Right, a little bit more.
So, well, Tony, remember, I want them to be outside the bands.
Oh, have to be outside the back. Got it. Okay.
Yeah, because I want them to be outside the bands. That's why I wasn't, that's why I couldn't explain this right at the beginning, because I didn't tell you what a Bollinger Band was.
Got it. That makes sense.
Cool.
Yep.
Very cool. Good question.
Hey, Chris, I was gonna say that the tweezers remind me of like a U-turn, like the price action has gone careening off of the road, and then somebody has spun the wheel around, and you know the car's driving back inside.
Yes.
And I was also going to say that for people that are sort of starting their stock research, or like you're starting to look at charts, tweezer tops and tweezer bottoms are very easy to spot. And so they can be a good, like, you know, if you haven't done any starting research, that's what I started with, because they were easy to see and find, and you can see for yourself how good they are.
That's cool.
Yeah.
Very cool. Very cool. I just got Paul, thank you for that. I got a couple notes here on in the question box. People are just saying, hey, you know, I got stuff from Len, love them. I've got 3 or 4 of those. I got about 5 texts. So a lot of votes of confidence in him. Raj, go ahead. You had a question?
Hey, Chris, did you go through all your questions on the text message?
Nope. I got.
Okay, I'll wait.
I got a shitload of them. Go ahead and ask me. You gotta just ask me now since I got you.
So for MACD, do you always wait for MACD to cross against you, or you just wait for 2 and 3 to cross and the candle to close before extending the trade?
Awesome question. So what he's saying is,
I've noticed when I wait for MACD to cross, you leave profit on the table.
you give it all back. So Raj, that's a great question. You don't want to, so what he's, if you didn't hear his question, let me give you an example on a chart. In fact, we'll use this one. let's say that here you were trading the stock down, right? So on the SPY bottom coming down, we're all looking and saying, yeah, that's great, it's going back up. Let's say that you were trading it down. And let's say there was an entry here and you got in, you're coming down. There's not an entry, don't worry about it. Just go with me. Just say that there is. And so now you got an entry coming down, 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 down. It's way outside the bands. You probably should close the trade. And now it comes back inside the bands. Well, that's a tweezer. Now you know it's going to be heading, pretty likely it's going to be heading back up. And now in this next candle, looks like it's crossing. And by this one, it's definitely crossing. And so if you wait to exit, if you wait for MACD to cross going against you and then say, that's my exit, understand what you gave back, right? We're up here at about whatever that is, 85. And the low down here was 66. Look at all that profit you gave back. And so and this is the point when I said about those emotions when you're in denial, not only if you wait to get out here when everything crosses going against you, not only you're in denial that price is going the other way, but you gave back a huge chunk of your profit. And so the idea is, right, as it's going out, you get, even right at this candle would have been an intelligent exit, that little wick, this one at the band or this one at the band, any one of those would have been fine. As this one, as it's forming, as it's going back inside the band, get the hell out. You're done with your bearish trade. You got what you're going to get. If it goes down a little further, so what? Doesn't matter. You got the nice chunk out of the middle, and now you wait to see what it's going to do and see if it gives another trade. It might give you another bearish trade. It might give you a bullish trade. That's fine. But Raj's question and his point actually was, if you wait for MACD to cross going against you and use that as your get out point, you're going to be sorely disappointed because you're going to give back a lot of profit. So Raj, thank you for that.
And Chris, for the sake of benefit of others, trust your indicators. I mean, this thing works fabulously if they haven't realized that already.
Yep, perfect. Nice. I think I got like 7 notes here about everyone loving Len. I hope you guys send notes to Len that say you love me. Let's see. Oh, Natalie got your question answered. All right, cool. Let's see what else we got. Covered that, get your monitors. I think all of you have the most recent watch list. I created it in September. So if I have sent you a watch list from September, you got it. If you don't have it, let me know. In fact, you know what? Don't even let me know. I'm going to make it easy for you. I'm just going to do a blast to everybody on the distribution list, and I'll send out that watch list to all of you. So that way I don't have to get a whole bunch of emails. I'll just do a blast to everyone. If you already have that email, if you already have the watch list, just delete the note. You don't need to do anything about it. Nothing has changed on there. There was one company on the watch list that was called, ticker was SHLL, and they got acquired, or they did an acquisition, and I can't remember the name of what. If you do a Google search on it, you'll see it. It was like Hyperlian. I can't remember the name. Someone will tell me the ticker. I can't remember what it is. But they got replaced. That was the only change that had been made. Somebody who's on there can look at the watch list. What was the one that replaced Shell?
HYLN.
What is it?
HYLN. HYLN.
HYLN. So when you look at the quote sheet, if I remember, I'll change it. If I don't, just remember, change SHLL to HYLN. And everything else on that quote sheet should be fine. And let's see. So you'll have all that stuff. If you haven't got Q charts yet, you all should have it. But if you haven't, reach out to Len to get that. Not Len, Joe at eSignal. And he will set you up with the workspace as well. And or go to TD Ameritrade, set up a brokerage account there. They'll give you access to Thinkorswim, and then go to YouTube and do a search like I showed you before to go find the video that Lam made, so you can get Thinkorswim set up to look like Q charts. Here's your homework. Based on what we've done so far, you've got your reading list. Go on to the POW's website, hit book list, go order a chunk of books. So they're waiting for you. Just start plowing through them. Don't wait on your reading. Just start going through it. Keep working on the news homework. I didn't ask about how you're doing on that. I assume you're doing it. I'm not going to be your teacher, if you will. You know, the nun slapping your, hitting your wrist with the ruler like you're in Catholic school. You know what you need to do. If you want to hit freedom, do the work. You don't want to hit freedom, take a shortcut. You'll be working for a lot longer. You're looking for 6 news trades or 6 companies that are impacted by news every night. 5 nights a week, that's 30 per week. If you have not yet done the high-low homework, take the time to do that. Go back and listen to that section in class 1. It's well worth the time because it will open your eyes to see how much stocks actually move in a short period of time. If you don't understand options yet at the basic level of, these are all the components, you understand the premium, the expiration date, the strike price, etc. If you're still a little confused on that, keep rereading that options overview document. Like I said, put it on the nightstand, have it be the last thing that you read before you turn off the light. Work through that options homework if it didn't make sense. Nobody asked a question, so I'm assuming you all got it. And then every night you work on your daily journals. You do one for the stock market, which is and early on, if you want to plagiarize from briefing.com, I totally get it. But in the next couple of months, you should be able to start writing your own based on your growing understanding of charts. And you also want to start writing a personal journal about aha moments, questions, things you notice, either the good, bad, or the ugly in your behavior and in your performance, because you'll be able to look back on that and see how far you've grown. If you've not contacted Q Charts, I showed you how to get there. It's esignal.com, click sales, ask for Joe. He'll help you load the provided workspace. And again, if you are going through Thinkorswim, I'm going to send everybody out the workspace. If you need it, you'll have it in the next day or two, or next couple hours. I won't lie. You'll have it at some point tomorrow. I probably won't do it tonight. And let me think. Your homework. Practice the news, write your journal, go through your watch list. What I want you to do from this point forward, once you get the charts, find 2 good trades per week. A good trade to me is a 3X. So you want to have Stoke, MACD, and price crossing on the same candle. I don't care what time frame it's on, go find 2 of them. And you can do it either on the right edge, looking for what's coming up tomorrow, or if you want to go back in time, take a stock back X number of years and just see if you can find those. The easy way to do that is, if you're going to do that, take the charts back in time. On Q Charts, you can do a control left arrow. So whatever stock you're on, whatever time frame, just hit control left arrow. Hit it about 6, 7 times, 12 times, 22 times, doesn't matter. It'll take you back in time. And now just looking at that screen, without looking at the right edge, even look in the middle of the page and find a spot, if you can, where price went down, hit the band, spread the band, came off the band, and then gave you what looks to be a reasonably clean 3X. All the indicators crossing. And now move that candle to be the candle on the right edge. And now once you see it, I go, oh, that's what it looks like as it's setting up. And then go, control right arrow. So now go forward 1 screen on your page and see if you can find another one of those. And when you find one, move that to the right edge and go, oh, that's what it looks like. That's what I'm looking for an entry. And do that again and again and again and again and again. And do that on bearish setups, do that on bullish setups. And that's what the 3X looks like. Now, just because you said the 3X number, that doesn't mean it's a trade. You then have to go back and look at the larger time frame, at the trend chart, and I gave you the relationship between those to see what those indicators look like and if it makes sense to do the trade. And if you do that, I promise you'll see this soon. If you don't want to do it, I hope you get there eventually. But I'm telling you what to do. It's your choice. If you don't want to do it, the fuck are you sitting in the class for? Right? Go learn this on YouTube. Why pay somebody to teach you what you know if you're not going to do it? Doesn't make any sense. And then I want you to also find 8 bad trades per week. A bad trade doesn't mean, if you want to start off and just pick some random garbage, just see what happens, cool. That'll just show you that throwing a dart at the dartboard doesn't work. But then what you want to do is find one that is almost good. it might be maybe not crossing perfectly. Maybe it's within 1 or 2 or 3 or 6 candles of crossing at the same time, and see how those work out. And in doing that, you'll be able to refine your criteria that says, how far from perfect are you willing to stray? And your bad trade could be one that's going against the trend chart. And watch how often those work versus don't work. And that will train your eye to say, oh, I've seen this before, this doesn't work, let me skip it. I'll only look for the prom queen off of those good trades that you've been practicing. When I do this, we do it on paper. I call it paper trading. I don't not call it virtual trading. What I want you to do is literally write it down on a sheet of paper. And the reason why is you'll treat it with more respect and you'll pay more attention to what it says and what you're seeing if you take the time to write it down. If you just do screen grabs, it doesn't stick in your mind, I promise you. That lots of people that started off doing virtual trading and then they come around to paper and they come back and go, wow, I should have listened to you, you're right. It really does make it stick in your brain. The mere fact that you have to write it down and not typing, write it by hand. It sticks in your brain. And all you're looking to do is log the stock price at its entry and at its exit. And it teaches you proper entry. Exit will take care of itself. You can see it when you're just doing it the way I'm talking about. And then over time, now you're going to start refining this. Okay, my exit is $1.50. Or you'll use the other exit criteria that are listed on that rules with the exit page. Then what you also want to start doing is also start printing the options chain. And you want to print the chain at the point that you enter the trade. And then you want to print it every day that you're in the trade. And then you print it when you exit the trade. And when I say print the options chain, you probably want to print next month and 5 months out. So you can see the difference between buying a nearer term option and buying the appropriate one with 5 months of time. And what you want to do is save that output. You don't need to study it now, just save the options chain that you're printing. And when you're done, you're just going to staple it to the back of the sheet that says, here's where I got into and got out of the trade. And just file it away. Throw it in a manila folder in a file drawer. And give it a few months before you go back and analyze it. Because if you try and analyze it sooner, you're going to waste hours and hours of your time trying to figure out why options behave, why they behave the way they do. If you'll instead spend the time on training your eye to recognize proper entry and an intelligent exit, and now once you can do that, and you do what Nat was doing, where he had 30 some odd, 30 out of 32 or whatever his number was. What he had, he had 17, and then he got the next 15. So 32 out of 33. I didn't ask him what he learned about the options yet. I don't care. Because what he's doing is he's teaching himself to be able to spot an entry. And then he gets the exit. And if he's been saving the options output, and if he hasn't been doing it, he's going to hear me say he'll go back and start doing it now. He'll grab that. And now what he can do, once he knows that he can spot the entry, and he's got 30 some odd in a row, now he can go back and study the options and see how they move and see how they don't move and see how sometimes they behave normally and sometimes they behave like a psycho zombie. But if you just get 1 or 2, it could be that the 1 or 2 you get are the psycho zombies, and you won't have any baseline of knowledge to be able to recognize that. But when he's got 30 some odd winners and now goes back and looks at the options data on there, he's going to spot something like, this thing doesn't seem right. Let me look at the next one. Oh, this one's behaving. Oh, this one's behaving. This one makes sense. Wait, this one doesn't make any sense. Okay, not worry about it, right? And it's so much easier for him to analyze the options behavior and not get caught up on that wild hair one. Okay. Again, it's paper trading. It's not virtual trading. Virtual accounts with options are an absolute waste of time. The option prices you see in a virtual account typically are not accurate. Don't waste your time. Okay, at this point, you know what I do for my homework every night. The only difference between me and you is about 20 years on charts. But I've given you a huge chunk of what I know. And the only reason I can't give you more is your brain is already hurting. You already feel like the tank's overwhelmed, right? Your tank is full. You've probably been gasping for air for the last couple hours. That's very normal. You'll also notice I'm not watching the clock, right? I told you we'd run between 7, maybe 8 o'clock. You'll notice I took a lot fewer breaks than I typically do. When I run this class in a hotel, we'll take an hour for lunch. So we cut an hour off that, and I covered even more tonight than I typically do in the hotel. So I know that a lot of you are like, my God, my tank is full. And some of you are saying, dude, you're a brave man. I was going to say Halloween. It's Valentine's Day and you're keeping us till 8 o'clock at night. The smart people celebrated Valentine's last night. Especially the guy that knew he was going to be talking till 8 o'clock tonight. And those of you that knew you're going to be on the phone till 8 o'clock tonight. What you want to think of going forward, I'm okay with you getting tired doing this because you got to get used to getting tired doing this. You will become an overnight success at this. It'll just take a lot of overnights. And nobody will see the overnights. The only people that know you're doing the overnights or the late nights are those that share the house with you. But people that you work with, friends, family outside the house, they're not going to know. And then X number of years down the road, there will be a big splash event. And it could be that you leave your job. It could be that you change your standard of living. Who knows what it is? And people will be curious. So like, whoa, that guy's an overnight success. Because he wasn't doing, he was working yesterday. What's the difference? And what they don't see is that you spent a few years doing the overnights. But they see the final result, not understanding the work that gets put in. Those 5 years are going to pass, regardless of how you spend your time. You might as well spend your time doing something productive, such that in 5 years from today, you will notice a big difference. It's totally up to you. Any final questions before I shut this thing down? Oh, Jada said, one thing here to print out the options chain every day that we're in the trade doesn't matter whether we print it at a certain time in the day. So Jada, let me answer it this way. What you want to do is print the options chain at the close of every candle. So if you're in on a daily chart, you print it at the end of the day. If you're in on a 233 chart, you would print it at the end of every 233 candle. And there's 2 of those in a day. If you're in on a 55, then you would print it every 55 minutes. But you want to print it at the end of every candle, which will be based on what the time frame is that you saw that 3x. Does that make sense? I'm assuming it makes sense. You don't need to, if it doesn't make sense, send me a note.
Yeah, it makes sense. Thank you.
You're welcome. You're welcome. Other questions?
Quick question. Being that it's COVID and we're all behind the computer monitor, what is the likelihood of actually having a live session sometime this year? Does it look kind of like we're not going to be doing that, or what do you think?
No idea. Yeah, no clue. There's a number of people in the call that I have a huge amount of respect for. And I know they've been going through some health issues. The last thing I would want to do, and the last thing they're going to want to do, is show up in a room with all of you. Right? I got people that are cancer survivors. I got all kinds of other stuff going in there. I guess, I didn't even think about it. I guess I'm a cancer survivor too. I don't fucking think of it that way, but I went through it. I don't know if I'm at more risk or not. I don't necessarily generally have a fear of going out. I'm not really that concerned about it, but I'm smart about it because I still hang with my parents, right? And they're both in the 80s. And so I'm not sure that I want to put them at risk or not go see them for a few weeks. So at this point, Albert, I don't know. I mean, I actually would love to get together with a group, right? It's really tough just staring at this screen. I get tired of looking at a Word document with my speaker notes. And I miss the interaction of the people. I know the people that have been in the live class, many of them are like, Hanson, please set up and shit and meet in a park, right? They would love to get together and just be able to mingle with people that are like-minded. I know everybody wants to. I'm sure we'll do it at some point. I just don't know when. And I'm not running around in fear. I just want to be smart about it.
Thank you.
How's that for a non-answer? Dude, I should be a politician or a lawyer or an economist. None of them give you a straight answer. But Albert, does that make sense? You follow my logic?
Yeah, absolutely.
Yeah, cool.
Chris, sneak in a question about indicators?
Yeah, Paul, what you got?
So Stoke RSI. So the reason that we don't use the terms, like when you research Stoke RSI, they'll assign a certain term to something over 80 and something under 20. And the reason you don't like those terms, or the reason we don't use those terms is because they affect the way you think about what the stock is doing, right?
Exactly.
And so you do not want to presuppose that over 80, a stock is doing something, or under 20, it's doing something, when that in fact is not true. You want to wait until the indicators and the price action prove that it's doing that.
You got it. So here's an example of, so somebody before had asked me, hey, what is that? What are these horizontal lines here at the, these are called the 80 and 20 line. If you go read the textbook on this, they call this the overbought, oversold. I hate using that word, and you'll never hear me use it. Paul, thank you for not using the word. But you'll notice right here, see how the price was above 80. And so if you read the textbooks, they will say, once it's above 80, you probably don't want to be buying because the stock's done going up. And so in this section here, they say, well, it's above 80, you shouldn't buy it, it's already overbought. But look what it did. It ran from there all the way up to there. And so it's a great example. It's like, you don't want to just use that indicator. And if you say, well, I don't want to be buying it because it's overbought, you're going to miss some nice moves in there, because there were definitely trades that could have been done there. You wouldn't capture all the move, but you could have got chunks of it. And if you'd gotten in down here and say, well, it's right here, it's overbought, let me get out. Damn, look what you gave up, right? You gave up another 10% on the stock. And that's on the NASDAQ, which says a leading stock usually moves like 3 times what the market average does. That says you had a 30% move there. And you got out because the textbook said when it's overbought, you shouldn't be in. That's why I don't like using that. So Paul, thank you for that. And thank you for not using the words. And you'll never hear me say them again. Let me see if I get anything else in here. Well, Sam, I appreciate you vote for me. All right, tell Len you would. Awesome. Yeah, Jada, if you could hold the question about divergence, I'll cover that probably in class 5 once I've had a chance to go through other stuff. So I'll cover it there. All right, everybody, it's I got you out before 8 o'clock. Have an awesome Valentine's Day. Go give a hug and a kiss to the person that's special to you, or make them give a hug and a kiss to you because you're special to them. And I will see you in 2 weeks. Have a great night.
Thanks, Chris. Thanks.
Thanks, Chris.
Thank you. You're welcome. You're welcome.
Thanks, Chris.
Thanks, Chris.
Chris,
what you got, Kongi?
Beside the book list for POW, is there a book list for Fast Track?
No, there will be books that I bring up along the way, and I'll tell them about you in each class.
Oh, okay. I just finished. I finished last week the book list for POW. I really liked it. I read a lot of books like double time, like 2 times too, just because it was really good. Especially Reminiscence of the Star Operator.
You like that one?
I read it like 3 times. I listened to it 2 times, read it 2 times. Yeah,
it's very good. Did you buy all the books, or did you get them from library?
I have a Kindle, and I have a way to like download most of it for free.
Okay, cool. What I would suggest you do, and this sounds weird, go back and read them again. Okay. And you'll be amazed. Yeah. You'll pick up different stuff from it. And then what you also want to do when you get to the book, Success is Not an Accident. If you haven't done so already, do the exercises that he lists out there.
Yeah, I tried a lot of it.
Okay.
Yeah, it's really good. I really liked it.
Yeah, that's awesome.
I noticed that there's 2 more book extra on the website than the book list you printed on the menu.
Yes, go ahead and grab those 2.
Yeah, those are really good too. I read it too.
Which one was that? The
Don't Eat the Marshmallow Yet and Living with a Seal.
Say it again. I didn't hear you. What were the 2?
Living with a Seal and Don't Eat the Marshmallow Yet.
Yes. Yeah. Living with a Seal.
Those are so good.
Yeah, exactly.
Yeah, because of that book, I started reading and listening to the Can't Hurt Me.
Oh, nice. Okay.
Yeah, that book is really good too. It's like a 2.0 version of No Excuse.
Yes, exactly. Except in No Excuses, You know, he uses proper, you know, the, what do you call it? Language you hear in church. And when you read "Don't Hurt Me," it's language you hear at the what do you call it? The longshoreman bar.
It's really good.
Very cool.
But
all right, everybody.
Thank you so much.
You're welcome, Claudia. Have a great couple weeks. I'll see you in 2 weeks.
See you in 2 weeks. I'll see you next week.
Oh, that's true. Okay. Good night, everyone.